Hello, and welcome to the latest edition to our Fixed Interest podcast series. I'm Erich Arispe Morales, Head of Emerging Europe Sovereigns at Fitch Ratings. And today I'm joined by my colleague Malgorzata Krzywicka, Associate Director in our Emerging Europe team and lead analyst in a number of sovereigns in the Central and Eastern Europe region, including Hungary and the Czech Republic. In this occasion, we will discuss the recent evolution and outlook for public finances in the CEE region. Malgorzata, maybe to begin, we can provide some context to our listeners of the status of public finances in the region pre-pandemic.
Thanks, Eric. When talking about the pre-pandemic trends, let's focus on the developments observed between 2015 and 2019. Over that period, the CE sovereigns ran relatively prudent fiscal policies, and almost all CE countries complied with the Maastricht deficit limit of 3% of GDP, while Bulgaria, the Czech Republic, Croatia, Lithuania, and Slovenia were in fact running budget surpluses. The general government balances in the CE region compared favorably with respective peer medians. Undoubtedly, the public finances benefited from strong economic growth observed in the CE region over that period, which was underpinned by strong private consumption and investment activity. The economic growth averaged more than 3% in all countries, outperforming the EU and their respective rating peers. Prudent fiscal policies and strong growth supported the reduction of debt levels across the region. Between 2015 and 2019, the gross general government debt levels declined by more than 10 percentage points in Slovenia, Croatia, and Hungary. Although the debt levels in these three sovereigns exceeded their respective peer medians, elsewhere in the region, public debt levels were broadly in line with the respective peer medians, which stood at just below 40% of GDP for the BBB and the AA category, and at 47% for A category. Two sovereigns, namely Estonia and Bulgaria, stood out, with their debt levels being well below the peer medians. Improvements in public finance metrics and Fitch's expectations of sustained prudent fiscal stance were in fact key drivers of rating upgrades of some CE sovereigns between 2018 and early 2020, namely the upgrade of Czech Republic and Estonia to AA- in 2018, Lithuania's upgrade to single A in early 2020, and upgrade of Croatia to investment grade in June 2019.
Thank you. So, from this relatively strong starting point, what has been the impact of the successive shocks in terms of the pandemic and war in Ukraine, and also the government's policy responses? What has been the impact on public finances and ratings?
The government response to the pandemic shock resulted in sharp widening of budget deficits and increases in public debt levels in the CE region. In 2020, the general government balances turned into deficits across the region, ranging from 3.8% of GDP in Bulgaria to as much as 9.3% in Romania. The deterioration in public finances came mainly from higher budget expenditure and reflected government support measures that included higher healthcare expenditure, employment support schemes, direct support to businesses, and increased social benefits. Although budget revenue remained surprisingly resilient, the increase in spending pushed up the debt levels significantly across the region, with debt to GDP ratios exceeding levels observed in 2015. The public debt to GDP increased by around 10 percentage points across the region between 2019 and 2020, with the sharpest increase observed in Croatia and Slovenia, while public debt to GDP rose by less than 5 percentage points in Bulgaria. However, the deterioration in the public finance metrics in the region was in line with the developments observed for rating peers. Certain permanent policy changes enacted around that time also added to fiscal pressures. I'm referring here, for example, to the massive 40% pension hike introduced in September 2019 in Romania, which pushed the fiscal deficit to 4.3% of GDP in 2019 and resulted in opening of the excessive deficit procedure by the European Commission against Romania in spring 2020. Changes to personal income taxation implemented at the beginning of 2021 in Czech Republic resulted in a permanent widening of the structural deficit by about 1.5% of GDP. As a response to the sharp increase in energy prices due to the war in Ukraine and subsequent rise in inflation, regional governments implemented various ad hoc support measures. Initially, the increase in inflation had a positive impact on the budget revenue in 2022, which in fact resulted in budget deficit narrowing that year toward or even below 3% of GDP, with two exceptions, that is Hungary and Romania. In Hungary, the cost of pre-election fiscal easing in spring 2022 and much higher budgetary cost of the utility price caps kept the deficit at 6.2% of GDP, while in Romania, the fiscal position had been much weaker prior to the shock due to policy changes. Sharp rise in inflation resulted in monetary tightening by the local central banks and also by the ECB, which pushed the borrowing costs for CEE sovereigns. In most of the cases, the increase in interest expenditure between 2021 and 2023 was relatively gradual, with Hungary being the outlier. The interest expenditure rose from 2.3% in 2021 to as much as 4.7% in 2023, reflecting the sovereign's shift toward retail financing with high reliance on short-term inflation-linked bonds. Despite wider fiscal deficits observed post-pandemic, the strong nominal GDP growth seen between 2021 and 2023 counterbalanced the negative impact of deficit widening on the debt dynamics. As of end 2023, the public debt levels were below the pandemic peak in most of the CEE sovereigns. However, compared to the pre-pandemic level of 2019, the situation looks more challenging. Croatia was a clear regional outlier, as by end 2023, it reduced the debt level by 23 percentage points from the pandemic peak, among the strongest debt reductions in the EU, bringing its debt ratio 7 percentage points below the 2019 level. This, in fact, was a factor in our recent upgrade of Croatia to A-. Despite the fiscal pressures that the CEE region faced between 2020 and 2023, the ratings proved broadly resilient. The fiscal buffers that had been built prior to the pandemic allowed the regional governments to implement support measures in response to the consecutive shocks, softening the impact on the economic growth. Nevertheless, there were some negative rating actions in the region over that period of time. Fitch has downgraded Slovakia's IDR to A- in December 2023 and Estonia's IDR to A+ in July 2023 due to the deterioration in fiscal metrics as well as implications of the war in Ukraine on the macroeconomic performance. And the second factor has been particularly relevant in case of Estonia. The risks around energy supply and the impact of energy price increases on growth and inflation, as well as public and external finances, were behind the outlook revision to negative on Hungary's BBB rating in January 2023.
As we move away from the global health and energy crisis, what are the main sources of pressure on the CEE public finances now?
While the big part of the temporary measures related to the pandemic and energy shocks have either already been or will be withdrawn by 2024 in most of the CEE economies, the two shocks had a longer-term impact on budget expenditure. As mentioned earlier, the revenue-boosting effects of the sharp rise in inflation observed across the region in 2022 faded, but cost of wages, pensions, and social benefits went permanently up due to extraordinary indexation. These increases resulted in higher budget rigidities across the region, complicated the needed fiscal consolidation, as it will have to rely to a bigger extent on the revenue measures, as spending cuts might prove challenging. The share of wages, subsidies, and social benefits to budget revenue went up since 2019 in all CEE countries apart from Croatia and Romania, with Romania seeing improvements in the revenue collection. While regional central banks and the ECB began to ease monetary conditions, we expect that interest rates will remain above the pre-pandemic level, keeping the interest expenditures at a higher level as well. The war in Ukraine resulted in a significant increase in defense and military spending in most of the CEE region. According to the NATO definition and data, all CEE countries apart from Croatia and Slovenia are expected to fulfill the 2% of GDP guideline in 2024. The increase in defense and military spending was the biggest among the Baltic states and in Poland. These countries plan to further increase and maintain the high level of defense spending in coming years, with Poland targeting as much as 5% of GDP in defense expenditure in 2025. Beyond spending pressures, the macroeconomic outlook is obviously important when discussing the fiscal situation in the region. The CEE growth dynamics proved more resilient to pandemic and inflation shocks than initially anticipated, and we expect GDP growth to pick up across the region in 2025 and 2026, supported by solid private consumption and EU funds inflows. Nevertheless, energy price increases, higher labor costs, and persistent labor shortages, also weak external demand, in particular from Germany, which is the key trading partner for most of the CE sovereigns, and elevated uncertainty will keep growth dynamics in coming years somewhat below those observed pre-pandemic. For some sovereigns, the loss in external price competitiveness might also weigh on the potential growth in the coming years. The external shocks to growth and loose fiscal policy push debt levels closer to peer medians across the region, with the sharpest increases since 2019 seen in the Czech Republic, Estonia, and Romania. Fitch forecasts public debt to GDP to remain above the pre-pandemic levels by 2026 across CEE, apart from Croatia, Hungary, and Slovenia.
As we evaluate the efforts towards fiscal consolidation in the region, what will be our focus when evaluating the fiscal plans for CE sovereigns? What are the main risks for the region's sovereigns in their fiscal consolidation efforts from our perspective?
In summer 2024, the EU fiscal framework has been reintroduced. Under the new EU framework, countries have to present their medium-term fiscal structural plans, which will outline their fiscal trajectories starting from 2025. At the same time, the European Commission initiated the excessive deficit procedure, EDP, against Hungary, Poland, and Slovakia, as fiscal deficits in these countries exceeded the 3% of GDP threshold in 2023. Romania has been subject to the EDP since 2020. The EU member states that are subject to the excessive deficit procedure can choose between a 4 and a 7-year adjustment period. The longer adjustment period would be allowed if a government commits to implementation of structural reforms. From the CE sovereigns that are subject to the EDP, Poland, Hungary, and Slovakia have already published their plans, and all three countries opted for a 4-year adjustment. We do not expect Romania to specify its consolidation plans until after the parliamentary elections in December. The Slovak consolidation plan is mainly based on the revenue measures that include a 3 percentage point increase of the VAT rate and some additional tax increases. On the other hand, Poland plans to implement few smaller revenue measures, which highlights the fiscal consolidation challenges. Expenditure cuts, as seen during the pre-pandemic consolidation, may prove difficult given the increased spending rigidities.
In our latest data comparator from September, we forecast that fiscal deficits will remain above their pre-pandemic levels for all CE sovereigns and above their respective peer medians for the sovereigns that are subject to the EDP. Therefore, when we will be assessing the medium-term plans, we will be looking at the type and the feasibility of the proposed measures. The implementation of the plans will strongly depend on the macroeconomic outlook, and while we forecast a GDP acceleration in the coming 2 years, the growth dynamics will be more muted than pre-pandemic. The political cycle over the next 2 years will also play an important role and pose a risk to further consolidation. We will see the presidential election in Poland in spring 2025, parliamentary election in the Czech Republic in autumn next year, followed by parliamentary election in spring 2026 in Hungary. Lastly, the geopolitical situation will remain an important factor for the CE sovereigns.
Thank you, Malgorzata, for your insights, and thank you all for listening. For more information on Fitch views on Central and Eastern European sovereigns, please visit our website, fitchratings.com.